Hi everybody, and welcome back to video number 3 in chapter 6. And when we left off, we were looking at deposit tickets. And this is the document that I'm sure you're all familiar with that we use to deposit money in the bank. And it lists the cash and the checks along with the amounts. So as you can see from this example, we have a lovely deposit ticket, and it it's basically a summary on the front, and then we have all the checks and detail on the back. Very typical. And it's a document that we use to list the checks and cash, and it's a proof of that deposit. And a check, very important, you use to withdraw money from the bank. We include the maker. That's the maker. That's a key piece of terminology. The payee and the payer. The payer in this case is the bank. Um, and this is a very nice check that shows our descriptions, the gross amount, the net amount, any deductions you might have, etc. Notice too, it has a check number, very important. Sequential control of checks is critical. All right, and then our bank statement, we get a lot of information from that bank statement that we don't know until we actually receive it at the end of the month or period. And here is an example of that. We have some check printing charges. We have some um, um, interest that's earned. We have some other items here involving some checks that have cleared. We can see that check 124 and 126 have not cleared the bank yet. And so it gives us an ending balance of $2,050, and we go from there. You'll see that in a second when we go through the bank reconciliation. So normally we do this once a month or once a period, as I said, and it's showing the activity in the account. Now the bank reconciliation is probably the most difficult section of this chapter. So what I always do, and please listen to me when I say this, I do the bank side first. Here's the bank side, here's the book side. And what we're trying to do is make sure that the difference between the cash reported by the bank and the cash reported on the company books are correct. So what we do here, we start with the bank side. We start here with the bank balance at the end of the month. And then we add any deposits in transit. That's deposits that we have made that have not yet been recorded by the bank, right? And then we subtract what we call outstanding checks. These are checks that we as the company have generated but have not yet cleared the bank. And we get an adjusted bank balance. That's all there is to the left-hand side. I always do it first because it's simple, right? Unless there's a bank error, which is very, very rare, but does happen from time to time. Now on the book side, we start with the balance per the book, and we add any interest earned or unrecorded cash receipts. We subtract any bank fees or NSF, that means not sufficient funds check. That's a customer check that bounced, as we would call it. And we add or subtract any corrections of our book errors. Any adjustments we make on the book side, we need to create a journal entry for that. Where on the bank side, there's no journal entries required. If the bank makes an error, we call them on the phone and says, please correct it, Mr. Bank. We don't do anything from the standpoint of a journal entry for that. But on the book side, any of these adjustments that we make, let's say for some printed checks that the bank did for us, we got to account for that with a journal entry. So here they're showing basically what I just went through. We start with the balance for the bank, add deposits in transit, subtract outstanding checks. If there are any bank errors, we add or subtract those, and we get an adjusted cash balance. On the book side, we start with the balance for the books, add any collections and interest, subtract any bank fees or NSF checks. We might have made some mistakes, so we add or subtract those, and we get an adjusted cash balance. These two items should be the same. And so anything on the book side, we're going to do an adjusting entry once again. Okay, so here is a good example of a bank rec from Video Buster. So they start out with the balance for the bank. They add their deposit in transit. And that's a deposit. Maybe we took that deposit down on October 31st and we put it in the bank and we dropped it in the bank. There's like a big mail chute. Yeah. And we threw our little bag of deposits in that mail chute. The bank hasn't processed that yet. So we add that to the bank side. And any outstanding checks, I think I identified them there, number 124 and number 26, that haven't cleared the bank, we're going to subtract those as if they did clear from the bank. And we get an adjusted bank balance. On the book side, the bank collected a note for us for $485. We got that from the bank statement. We earned that $8 of interest. So those are pluses to the book side. And then we have some expense for check printing and a customer that didn't pay that bounced a check to us. And as you see, the two items reconcile. But we do need to process adjusting entries for the book balance entries there, not the bank balance entries. Okay. And here are those entries. The notes that the bank collected, we're going to debit. You'll notice that all of these entries here involve cash. Cash is either going up or going down. So in the case of collecting the notes, the cash went up. We credited the notes receivable to wash it off the balance sheet. And then here we've earned some interest, so we had some interest revenue on the income statement, the debit to cash again. But we had $23 worth of printing charges. We subtracted cash in this case and charged it to miscellaneous expense. And then looks like T. Wood was the culprit that bounced the check. And so we're going to put that back up as an accounts receivable. Now, in this particular case, you'll remember that when those checks come into our company, we assume they're good checks. And so we record that as a debit to cash and a credit to accounts receivable right then and there. Now, when we get the bank statement back, we say, ooh, that was bad. So we need to put the receivable back up here with a debit to accounts receivable and a credit to cash. Okay. And those are our adjusting entries from the bank reconciliation. All right. We'll take a look at computing the days uncollected ratio. That's pretty easy, and use it to assess liquidity. So here, what we do is we say, okay, our days sales uncollected is going to be our accounts receivable balance divided by net sales times 365 days. And so that gives us the days uncollected. We obviously want that to be as low as possible. And in both Starbucks and Jack in the Box's case, that is a pretty good number. They've done a pretty good job of collecting their accounts receivable. So, a measure of liquidity. Okay, how do we describe the use of documentation and verification to control cash payments? This is pretty easy. I think I went through this already with the purchase order, the purchase rec, the purchase order, the invoice, and the receiving report. That's exactly the vouching process for most of the items that we would purchase. So our invoice approval, the accounting department's going to record purchase and and approve payment after all the documents are in order. The information across all those documents need to be verified. The invoice approval is also called the check authorization. Whoops. And then we have a checklist of the steps necessary for approving the invoice and payment. Pretty straightforward. So the voucher then is complete after the invoice has been checked and approved, and it's used to authorize recording obligation, and certain information then is required on the inside of the voucher. Certain information is also required on the outside of the voucher, and that goes to the check signer who approves that voucher as well as the actual check. Well, that looks like we're wrapping up chapter 6. And when we return, we'll take a look at chapter 7. Until then, bye for now.